Have you ever heard the term angel investor and asked yourself, what's an angel and what do they do? Have you ever looked at the money going into the tech industry and asked, how do they make that money back? Well, if you have, you're in the right place. Because today, our focus is on investment strategies and the dynamics of exits in Nigeria and Africa. Today, we'll be joined by one of Africa's top angel investors, and together with him, we'll journey through the investment landscape in Nigeria and across Africa, examining the triumphs and challenges that angel investors face.
Hello and welcome to Tech into the Future, where we talk about everything that's happening in technology and how it affects you. My name is Ngozi Madre-Kadozie, and I look after Android partnerships for West Africa at Google.
And I'm Tomiwa Ladikomo. I'm the CEO of Tech Cabal, a digital publication that's been covering African tech for the last decade. Alongside Ngozi, I will be your guide into the world of tech in Nigeria, Africa, and the world. Today we're talking about money and exits. So a lot of money has gone into the tech ecosystem over the last years in increasing quantums. And it's been kickstarted by angel investors who had sort of the first sort of like real faith in what was happening in Nigeria's tech ecosystem. Mm-hmm. And then it's kind of gone up to institutional sums of money, and the money has gotten institutional.
Yes,
the money itself,
$200 million,
and $3 billion valuation. Yeah. So the money itself, it has weight, it has heft. And so we're going to talk a little bit about that money and what's come in, and then what's coming out. Are people actually making money from this ecosystem?
Exactly, because the whole point of investing is to make money, right? Yeah. And exit. So that's what we're talking about in this episode, is about exiting and how do you exit? What does an exit look like? Who are the people that are exiting?
Who's done good exits? And then what's shaking the market of the exits? Because it's been a roller coaster in the recent past. And so we're going to speak with somebody who's got a ton of experience in this, and he's going to tell us, are people making money? How they're making money? And I think we're going to ask him, should we be investing? What's the future? And where's the future money coming from?
I have my notepad ready for taking notes.
Fantastic.
So two things. Let's talk about one, the significance of an exit, and then you tell me the biggest exit you can remember.
Okay, so I think the significance of an exit is money coming out after going in. And what it is a signal for other investors that this is a market that's worth investing in. And so for angel investors, you have a whole sort of pool of HNIs, of sometimes not even HNIs, just people who have been earning a salary and who have a belief in technology, and they're investing sort of their life savings into this space. And so when you have an exit, it tells them, well, first of all, it gives them liquidity. Yes. And a really important thing of that liquidity is that they can then invest more. So somebody invests $10,000 in this thing, they get $100,000. Take $50,000 and go and say, hallelujah, the money no loss. But they also take that 50,000 that's left and they put it into 5 or 10 more companies. Indeed. And so that's how you build an ecosystem, is the returns encourage more people. And that happens at individual level, but it also happens at institutional level. So when somebody does a $20 million fund and then they get 40 or 80 or 100 million back, then they can actually gives them the confidence to put more into the industry. Exit. First exit?
Well, it's not the first exit, but the exit that comes to mind is Paystack.
Yeah. No, Paystack was really important. I mean, it's interesting because it's the most important, the most visible exit in this market. Egypt had a much bigger exit, so Swivel,
that's right,
listed on the NASDAQ at sort of a 1.5 billion valuation. Really, really important. But Paystack is sort of like our biggest sort of like company getting acquired, all the investors coming out. The other thing we'll talk about with our guest today is the is secondary exits. And so you have a few companies that have gotten to very big valuations, and so investors are able to take out money in secondary sales. And that's when they sell equity when a new round is being raised. And so some people have done quite well on that. Some funds, some smaller funds have done quite well on that. But in terms of proper exits, I think for bigger funds, there's still a long way to go for us as a market.
Can I tell you why I like the Paystack exit? Because the first time I ever was soliciting for us to use Paystack when I was working for a company that will not be mentioned, I said, you need to use Paystack. They're like the Stripe of Africa. I know, and then Stripe acquired them. I predicted that.
You know, that was their pitch from day one. We're the Stripe of Africa, and I mean, it is kind of a fairy tale story in terms of how they
It was like they
happen.
spoke it into existence. It's excellent.
They actually did. Stay with us. You're watching Tech into the Future, and we'll be right back with our guest after the break.
Welcome back to Tech into the Future on Arise News. This week we have with us Mr. Olumide Soyombo, the co-founder of Bluechip Technologies. Welcome to the show, Olumide.
Hey, thank you for having me.
So welcome. It's good to have you. I want to start by talking about your journey as an investor. So your background is technology, but how is it that you came to start putting money into startups?
Okay, so I started out Bluechip Technologies with a partner in 2008, primarily as an enterprise technology company. So building out data warehouse applications, business applications and software for many of the banks and telcos. Okay. And then in 2014, so we started out in 2008, by 2014, I started seeing what was happening in Yaba with CC Hub, with the advent of increased internet penetration, mobile phones. And I started to see with Bluechip, our revenue was very concentrated, like many consulting companies, amongst very few clients. So 2-3 clients were responsible for maybe 80% of our revenue. So I started thinking about how do I invest in platform-type businesses that can scale and be more B2C-like. So I looked at what Y Combinator was doing. So I pretty much copied the Y Combinator model of saying, I'll take some money out of Bluechip. It took about $500,000. Profit takings out of Bluechip to then start investing in startups through an accelerator model. This was 2014 into 2015. So we did the first call for entry, got a couple of companies to fill up our application, bring them in for 3 months, with the whole idea being that after 3 months, you put them in front of bigger investors. So those days you could do 25K or 50K for 15% in income. Those days are gone. But what we noticed really after we had the first cohort and second cohort was you put 50K in 2014, 2015 into a company, $50K dollars, right? Let me put the dollar figure out there. $50,000, $25,000 in those companies, and then 3 months time, like with Y Combinator, they'll have a demo day where there will be bigger investors who will write bigger checks. But in Nigeria at the time, there were no bigger investors to write any bigger checks, right? Check. There was no next check. So you had to write a second check again into those companies because you had seen them make some progress. But then everybody used to say there was no growth fund. There was a big growth fund gap. We had some PE guys who would say, these companies are too small. And then you had some of us who had tried to write checks, but who didn't have the firepower to keep on funding. So we scrapped the accelerator model and then just started investing directly into several companies that we found interesting.
So then it's safe to say that you started off as an angel investor.
Yes, very correct.
Okay, so are you still an angel investor, or has that changed for you in terms of your investing portfolio?
Okay, so very interesting question. As I started angel investing I probably had done about 30, 40 odd companies. So PiggyVest, Paystack, MoneyPoint, Lemfi, some very, very interesting companies. And we exited Paystack, did some secondaries in some companies. And venture as an asset class started becoming interesting to the average Nigerian HNI. And generally people picked an interest in venture, especially after the Paystack exit, right? That's what success brings, like success begets success, right? So people were like, Olumide, next time you're investing, please carry me along. You seem to know how to pick these companies. But I was very, very fine to invest my own money, right? It's one thing to invest your own money and lose it. It's something else to take people's money and invest it, and then they start asking you when the thing goes wrong, what will happen now, right? Those kind of things. But I saw that I was already, in a way, investing and syndicating deals, because I would see a deal very, very early, and that's the whole beauty of investing as angels. You get to see deals very, very early, and I get to see almost every deal that's interesting in the market. So I'm getting to see a lot of deals. I'll see a company like maybe Mono was raising 300K. I'm putting in 50K. It still needs 250K to do, so I'll call I'll call different HNIs, I'll call different folks, and then we'll complete the round, even sometimes over WhatsApp in the good days. And I then saw, okay, I can actually create a mini fund, which I'll be the major LP or investor in that fund, and then I can then catalyze more funding into, instead of calling different people at different times. So, but I never wanted to
park some capital inside this fund.
Yes,
and I will deploy it when I'm deploying my own.
When I'm deploying my own. So that's really the real play. But then I rolled it into one, and that was how Voltron Capital was born in late 2021, which is really my money and money from high net worth individuals, some folks from the Valley who are excited to see what was happening in Nigeria. I wanted to take back in the action.
Are you still taking capital into Voltron, or did you take capital at one time and?
Yeah, so the whole idea is take capital for each fund. It was a fund one. We deployed, I think, about 53 or 54 companies in about a year. So that was almost like a deal a week. And then now there's fund two, the same thing.
And you're deploying capital from fund two?
From fund two now, at the moment.
I want to break down kind of this ecosystem a little bit for a lay audience.
Correct.
So you've got your angel investors. Mm-hmm. You've got your institutional investors. Mm-hmm. So that will include funds like yours, or it will include bigger funds.
Like even within those institutional investors, you have different types of investors.
Yeah.
So you have seed series, so seed funds, and funds that mainly invest in pre-seed and seed stage.
Correct.
And so pre-seed and seed is very, very early.
Correct.
Angel would probably be around pre-seed, or sometimes even before that.
Even before pre-seed,
even
right?
Before pre-seed.
So pre-seed and before pre-seed.
Okay. And then you have then growth stage, so Series A, B, Series A, Series B. And essentially for each of these, it is as a business is being de-risked.
Correct.
Correct. So at angel stage, they have idea. Uncle Show, I think I can build the next Paystack.
And I've seen
to
so many.
solve X or Y. Mm-hmm. And then at pre-seed and seed, they're starting to have a product. They're showing you a product. Mm-hmm. Correct?
Some MVPs.
Some MVP. What's an MVP? I think we talked about
this.
We
talked about this last week.
Minimum viable product. So there's a product to show. And then by Series A, what do they have to prove to raise a Series A round?
By Series A, you're starting to show somebody's willing to pay me for this. A couple of people are willing to pay me. Yes, so a couple of people are ready to pay me for this. I need to put more fuel to this fire and scale.
So again, for a lay audience, at the point you're putting in $50,000, nobody has said they are willing to pay for these products. Mm-hmm. At the point where they are coming for seed round, sometimes, and we've seen, I remember when I joined Tech Cabal in 2018, one of my investors called me about the headline that we had written. Okay. And he said, what is a 1.5 million pre-seed investment? Mm-hmm. That was Kobo 360. Mm. So, like you said, in 2014, 2015, you're raising a seed round is $50,000. Mm-hmm. But by 2018, companies like Kobo were raising 1.5 million as pre-seed, which means they're not generating a lot of revenue. They have a product that's maybe starting to come into market, but somebody believes enough in them to invest 1.5 million that early in their journey as a business. So your $50,000 doesn't buy you 15% anymore.
It doesn't. To think about it, right, in our market in 2016, 2017, Hotels.ng Series A round was about $1.2 million, right? Yeah. Series A, that is finished all pre-seed, seed, and Series A was 1-something million, and it was well celebrated. So it tells you how far the ecosystem has also come and how the industry has also evolved over time.
Yes, I was going to say, is it that the ecosystem has evolved? Is it that, things that success begets success, right? And it's like, so you see something good is happening, and then you're like, you know what, I don't even know what's going on there, but you know what, Olumide, here's my money. It's almost like, since you have the path, right? Since you clearly have the eye to see these things, sometimes I do wonder if there was then overexcitement at some point, because now it seems like the market has kind of calmed down a little bit. So now, over the last 18 months, can you tell me what's the market looking like? So we've gone from the days of Hotels.ng when they were raising Series A at 1.2. Then we've gone to the point of Cobalt 360 that's doing a pre-seed at 1.3. Now, where are we?
I think sensibilities have come back. There's no longer any zero interest environment and zero interest regimes where I think some things didn't just make sense. Especially for me, I was investing in the pre-seed deals, and then further down the line, we'll push them to bigger investors. I was seeing some of the valuations some of our companies were getting. I won't complain, but I'm like, really,
can you return this money in the market?
Can you return this money in the market? So I think some people still kept their head down to build real businesses, and that's really what we are seeing now, the market correcting for people now focusing on the right things, right? Because in zero interest environment, I always tell people you can sell, if you say it's growth you're looking for, I can sell a $10 product for $9, I will grow. Right, but at what expense and to what end? So what we are seeing in the market now is, I think people everyone got excited, right? And I think it got to a point where nobody was afraid to build anymore, right? So everybody was an entrepreneur all of a sudden,
exactly,
for sometimes the wrong reasons, and they had money being thrown at them, and of course they will take the money being thrown at them, but then. I always say that even in a bear market or a bull market, so even in a down market or an up market, certain entrepreneurs are still super entrepreneurs, right? Tomiwa doesn't stop being Tomiwa because we're in a bear market, right? I would back the entrepreneur regardless. So what we are saying now is people are building real businesses. People are focusing on customers, on revenue, and I think it's the right thing for the market, right? Because for us to be able to have the real successes, and the real success at the end of the day is not how much we raised, it's how much was returned, right? Yeah. That's the only way we can catalyze more capital to build sustainable businesses in our market.
Okay, so let's talk about those returns and returning money. So I remember having a conversation with an investor in 2018. And they said, this tech thing, we've been putting money, the money hasn't come out.
In
2018.
Okay.
And then 2020 happens. Paystack's the big exit. There's a famous tweet of yours I gotta find and put on screen, money no loss. And that kind of opened the floodgates for people to come and put money in. But let's talk about the exits, from that point on. Actually, we'll start with the Paystack exit itself. How did that do for you as an investor? How many X's? How many X's? So we don't even want the nominal figures, but
it was good.
It was good.
It was good. I'll put it this way: if you play Russian roulette, what are the odds? It's 35 times your money, or something like that. If the number hits 7 or 1 to 35.
Interesting.
So you would get better odds if you had done that, if you had put money in Paystack, let's put it that way.
Okay. All right. So that's a nice return.
Nice.
That's a nice return. And I know that across Africa, we've seen some other exits, Swivel IPO, but most of the exits, I think, that have followed that have been sort of secondaries. We haven't had another big Paystack-like exit.
We need another one.
Yes, we do. We've been waiting for a couple of IPOs that have been delayed.
Sure.
But investors are making money.
Sure.
And, so I want to talk about that. How are investors making money? What does it look like to exit in a secondary? What else is happening in the market in terms of how money comes back to investors?
So it's a very, very interesting question, and one that's now top of mind for many investors. I was telling someone that if I'd raised the fund in 2015, that was a proper fund that was raised from LPs, from other investors, let me dumb it down, investing into a fund I created, it would have been most likely a 10-year fund, right? So 2015, by now, the fund would be getting its end of life, right? And if it was a $2 million fund or a $3 million fund, what would it have looked like if I was going to be exiting now? And I think largely we've seen if I look at some of the early syndicates, so some companies that, like Ventures Platform had syndicates, Future Africa had some early syndicates. we were investing also mainly as an angel investor. Many of those funds or syndicates, because they were very small, have been able to return money either through, for example, Paystack was a big moment. Many of the investors, Flutterwave have done a couple of secondaries. Many investors, early investors in the market, returned the
entire fund.
The entire fund because they were small.
Let's break down something like a Flutterwave. So people are investing in Flutterwave. I don't know what their first rounds, the early investors are investing at a valuation of
$1 million,
$1 million, $5 million. You're getting at $100 million, you think it's rich. And then they do a round at $1 billion valuation. And I mean, I happen to know at $1 billion valuation, a lot of people are like, hallelujah, we're going home.
I'm going home. A bird in hand is the only
And then
bet.
less than 6 months later, they do a round at a $3 billion valuation. And so if you exited at $1 billion, you're like, I left money on the table, but you were happy because you exited, if you came in at $1 million, that's...
So that's the way I see it, and especially investing in Africa, we have this saying that a bird in hand is the only bird. There's no two in the bush, right? You take what you can take while it's there, right? Because you talk about a sweet story like that. There have been stories of companies that could exit at $100 million. I think Tech Cabal even covered one of those stories.
There's a few of them. I was talking to an investor today.
I went to zero. Right, you had an opportunity to exit 100 million, and then something goes wrong, or some regulation snaps, or something happens, or some founder goes rogue, and everything burns to zero. So for me, is at every point there is an exit, especially maybe because I'm also investing as an angel, and it's mainly my money first in the kind of companies.
So you're happy to collect 5x and go.
I'm collecting 5x, 10x, and I'm partial. Right,
so you leave some money in.
You still play the game.
Let some ride.
Now I've de-risked away, and I've taken money off the table, and I'm comfortable if it doesn't return anything anymore. And I saw an article recently on Sifted and from the Speed Invest guys, and they were talking about we should have taken more money off the table in the bull run, right? We felt that we should ride this thing wave, but it seemed that in hindsight, we should really have taken some more money.
Hindsight is 2020. So I do like the bird in hand is the only bird. It's an interesting. Let me talk about what that does to the psychology of money. So Paystack exit happens, a bunch of HNIs come into the market and start to invest. So some of them would have invested in 2020, 2021. Maybe they've seen secondaries, maybe they haven't seen secondaries. How does the HNI react to the market? That's on one hand. On the other hand, you have LPs. And so LPs, for those who don't know, limited partners, these are the investors in big funds, the people putting money into a fund. And a lot of our LPs are Silicon Valley based, we've got some Asian based, a little bit of Europe, not as much. How do they view the market? So on the one hand, local HNIs investing in the market, and seeing sort of the turmoil of 2023 recently versus sort of international LPs, just from your perspective.
I mean, the way I see it and about the way I think about it is the investing in venture in Africa, right? You have to forget Africa for today. Forget the Africa that you see today. Right? If you think about, and long-term investors have to have that view, long-term LPs, long-term HNIs. If you think about every deal I've done, even the ones I've made money on, there are 10 reasons not to do that deal. If you're looking for a reason not to do a deal in Africa, there are many reasons not to do that deal.
Okay.
But if you think about the bet on venture in Africa, what's the bet on venture in Africa? The bet on venture in Africa is not today. It's not exchange rate at 1,400 today. That's not the bet that you are making. That's the bet the stockbroker or the guy investing in the stock market today or the bond market is making. But that's not the bet an early stage investor is making. A late stage investor might consider some of those things, but an early stage investor is not thinking about those things today. So you have to forget Nigeria.
So what is an early stage venture investor thinking?
So an early stage investor is thinking 2050, which is a few years, not too far from now.
26 years?
Time is moving. Time is moving.
If every president does 8 years, it's only 3 presidents away.
Fair enough.
When you think about it that way. And Nigeria, 2050, Nigeria will be probably third most populous country in the world with the largest base of young people. I used the internet, and I always tell this story. I used the internet for the first time when I was 13, and I was very, very lucky. The average CEO of a bank today probably didn't use the internet till he was in his mid-30s. But you have people building businesses today that were born in the internet, that are digital first, and are going to be living in cities. Who is going to build this? Those people are not going to walk into a bank to open a bank account. Yeah. Those people are not going to order first online. The bet is that they will have this set of young people, upwardly mobile, digital first, with a large population and a large talent base to build, and productivity would increase. That's the bet on venture. Is that I'm betting that this country or this continent is probably where India and Latin America were a couple of years ago.
Right.
And you've seen what has happened in those markets, and you're hoping it will happen in this market. So it's not exchange rate at 1.4 that you're looking at today.
You're looking at the power of technology to fundamentally change the way the economy works and to create...
Market creating innovation.
Market creating innovation.
Over a few number of years, right?
Yep.
So that's the whole point. It's not about today. It's about the future of Africa. But then that's a tough one.
It's very hard not to think about it,
that's a tough
right?
one. That's a tough one because, if you think logically and, you follow the trajectory in which we're moving, one of the conversations we've had in the previous episodes is talking about our readiness for the technology evolution and whether or not we are in that space, whether or not we are using the one resource that we do have, which is our numbers and our young population, whether or not we're upskilling them digitally so that they are the ones that are actually coming up with these ideas. I'm looking for pre-seeds because ultimately, I'm convinced that the ideas are going to come from us, for us, right? The reasons why the Paystacks and the Flutterwaves are so successful is because they were created here and they were bridging infrastructural gaps that we had in the banking system. That's just what that was, 100%. Right? And the truth is, the unicorns that we're going to see, quote unquote, if you have many of them, they're not unicorns anymore. But the successes that we're going to see in this space are going to be Africans that are creating for the African problems as opposed to the reverse. So then, if I'm then speculating what the next 25 years are going to be, the question I'm asking myself, not just in the idea, is whether or not we have the resources, right? The creative minds to actually build those things, if that makes any sense.
I think we do. And if you think, many times when progress is happening, you don't think to understand and appreciate it. But someone who started developing or writing code, or a software developer who started writing code 5 years ago, right, maybe building his first e-commerce site, would not remember that as at 7 years ago, you had to pay 150,000 naira to InterSwitch to get connected to WebPay.
Yep.
And you work over 2 weeks.
Very true.
So I can imagine you're talking to that developer now and say, oh, this is what people 8 years ago had to go through. He's going to look at you. But that was just a couple years ago.
Fair enough.
We don't tend to understand and appreciate progress while we are making that progress or while we're at it. And I said there are many things that we don't have a choice that would, because of human need, the market reaction, that we'll just have to build. So I'm constantly looking for companies, in my own view, that need to be built. There are many companies that need to exist in every market, right? And if you look at LATAM, Asia, India, many of those markets, China, yeah. You see certain companies just have to exist in every market. So, for example, in 2050, there'll be a unicorn in the e-commerce space. There'll be a unicorn niche e-commerce player. There'll be a unicorn wealth tech player. There'll be a unicorn digital banking player. Those industries or verticals have existed in every market that had similar traits and attributes to our market, and that's what you're betting on. And those entrepreneurs are here, right? Shola of Paystack went to Babcock, right? Odun and some of PiggyVest went to Covenant University. Those entrepreneurs are, in fact, there's even something to be said about schooling here. But that's a matter for another day.
We're going to come back. I'm going to talk a little bit more about this talent question, but we're going to go to a break right now. Don't leave. You're here with us on Arise News, watching Tech into the Future. We'll be right back.
Welcome back to Tech into the Future. We are here with Mr. Olumide Soyombo, and he has been dropping nuggets since the beginning of this show. Thank you for staying with us.
No problem.
Going back to the question or the conversation we're having earlier, you were talking about investors thinking about Africa or Nigeria with a 25-year lens when they want to invest. But when you look at the investments, a lot of them have a runway of, 10 years max? Mm-hmm. How do you reconcile the gap?
Yeah, so it's 10 years. A fund life will typically be 10 years, right? But the companies will still exist even after the funds have been returned. So I'm saying you invest in a company today, you have the outlook for your return of capital is not the end of that company. That company will still continue to exist in a different form or with different owners. So the key thing is, am I building a company that's going to be relevant? Am I investing in a company that's going to be relevant in 10 years, in 5 years, in 10 years, in 20 years, in solving those problems? So it's not like we are going to go from 0 to 35 and all of a sudden it's that eureka. There will be progress that will be made over that period, and there will be growth in those companies that you would see over that same period.
So these businesses might change Nigeria and Africa in 20, 25 years in really dramatic ways, but you'll start to see the impact in 5 years, and you will be able to recoup
value will
capital.
be created, yeah.
Okay, interesting. So it's been a rough market the last couple of...
You can say that again?
Yeah. What does that do to, and I think I asked the question, we didn't quite get to the answer, what does that do to international investor confidence in these markets?
I mean, it's everywhere. The same international investors are also saying...
They're struggling in their own markets as
and
well.
if you look at the data,
US
right?
public markets are doing nice.
Yeah. If you look, but in the venture market generally, right, it's venture winter. And for a while, we thought maybe Africa might
skip it.
Might skip it, right? Because we didn't feel that that lull until as early, but then it did eventually come. And I think some investors look at it and say, okay, what's the next frontier, right? Where are the next interesting things going to be built, right? It's probably in Africa, so I'm going to back here. And I think you're still seeing some interesting deals that are still being done. I've come from investing almost a deal a week to now investing a deal a month. But I'm still seeing some interesting companies that I feel need to exist, right? Whether we are in a bear market or in a bull market, or it's up, market is up or down, certain companies still need to be built, and we still need to back those entrepreneurs. So I think the focus now for those international investors would be, hey, how are you going to make money? You're not going to say you're selling $10 for $9 again. Those days are over. Everyone is focusing on unit economics now, even very, very early, and how to be sustainable. It's almost like we've gone back and put our thinking hats back on how to build real businesses. So in a way, it's good the ecosystem has gone through this.
So it's funny, one of the things that we had don't know that we predicted it, but we talked about it when we're looking into 2024. Mm-hmm. And we said that there was probably going to be a good number of M&As, and those would be as a result of the market not necessarily shrinking, but the excitement is kind of dulled, right? And so what you'll find is that some companies are going to see strength in coming together. Mm-hmm. It's interesting because that's not necessarily what we're seeing in the global market. I think there's been like an 8% decrease in M&As as opposed to on the continent where we've seen an increase of 33%. So thinking about 2024 and beyond, what are your thoughts around some of the M&As that you think we can, I don't know, we're not predicting, but you think we're likely to see?
Or what are you advising your portfolio companies re-M&A?
You wanted to tell us what he's advising his portfolio companies?
Oh, I'm sure I can.
Yeah, sure. I mean, it's something that's open sourced, right? It's I think the problem we've had with M&As in our market, and kind of M&As you've seen, and maybe TechAbal has even reported on, is almost like the marriage is arranged when the people are 70 years old and are ready to die. There's no time to live together. Right? The arranged marriage should happen earlier.
You see some of those, but you see some interesting ones. Yes. I think MFS Africa and it was Baxi, I think they were called at the time.
That was not good. That was not 2023, 2024 market.
Yeah, that was a bit
So
earlier,
I'm saying, you're saying the M&As when the people don't have time to to enjoy the best times anymore, right? So
we're not going to mention any of those.
No, but and I think those conversations need to happen earlier. And it's also the onus is also on the investors, especially common investors. And those conversations have started to happen in different WhatsApp groups and different meetings. That's what this market downturn has forced us to see. Yeah. And maybe we'll talk a lot about even the funds that were raised in several funds that $40 million funds, $200 million funds, there's a $300 million fund focused on Africa and what that means for our market down the line. But with the M&As that we need to look at is how do companies think about the size of their market? Like there are certain companies we've invested in and other investors have invested in similar companies too. Mm-hmm. Like really, what's the size of the whole credit decisioning, for example, right? In terms of an API company that helps with credit scoring, right? There are many companies that are already doing that. Let's put everybody into one and build. And
fair enough.
And build the final one.
And the final one, right? Because the companies doing some open banking stuff. What's really the size? Like let's assume you blow to the end, right?
How big can this get?
How big can this get? When two of you are now nipping at each other. So those kind of M&As need to be structured, especially with when they have common investors. Mm-hmm. And that's the kind of thinking that we need to have, even across the region, right? I had a call today with one of our companies looking at something in the Francophone region. How do we merge with such companies and build a super brand that can then even take more capital in and build bigger businesses? Those are the kind of opportunities I think we need to start looking for in the M&A market.
Fantastic. I think that's a good note to leave on. Just thinking about the future of the industry, thinking about mergers that actually build more resilient and important companies. Thank you so much for taking the time to join us today.
Thank you for having me.
Great to have you. We're going to go on a break right now, but we'll be back to talk a little bit more about the conversation we just had with Mr. Soyombo. Don't go anywhere. You're still on Tech into the Future.
Welcome back to Tech into the Future, where we just had an excellent interview with Mr. Olumide Soyombo. And there were some major takeaways. My first one is a bird in the hand is the only bird.
I like that view into the mind of the Nigerian investor or the African investor. It's like there's no future coming. Like exactly. Just collect the one that you can collect right now and go. Yes. No, I think it's really important in a market like ours, which is still in a sense a frontier market, is if you can get a return, secure that return. Exactly. Don't wait for a mythical one that may or may not come. And it's probably a more aggressive sort of route to collecting returns than you would in a mature market like the US. But the market you're in is the market that you're
not the US.
We're not the US.
And you know what? He also mentioned, you can leave some money in there, right? Just so that you don't.
So you leave some to ride. So just in case the thing continues to grow. But you take what you can now. I thought that was really important. But the other one I thought was really important is essentially the case for optimism. There are companies that must be built. Yes. There is a future that only technology can deliver for us. And it's important to continue to invest in that future. Downturn, bear market, bull market, it does not matter. Some companies must be built.
Necessary.
I thought that was a really, really sort of fundamental case that he's made. And it's a case for investment by our investors, by founders, and by the government and the regulators into these industries, because they actually still will change the way we do business in the future.
I also like this thing, and I think it ties into yours, right, is that there's the necessary industries that have to exist, and then when you're investing in the necessary ones and the ones that may not be as necessary in your mind, you're not thinking about them in the Nigeria of today. You're thinking about them in the Nigeria of 25 years. And, it was good for him to point out that, yes, 25 years seems like a long time, but it's 3 presidents if each president did, 2 terms.
We hope it gets a bit more competitive. No, but it was great to have him. And if you haven't, Olumide published a book called Vantage.
Vantage, yes.
Last year. And if you haven't read it, you absolutely should pay attention to it. If you're a tech enthusiast or you're looking to invest in the space, lots of lessons around what to do and how he's built kind of his presence in that space.
Another thing that he said that I liked was about schooling. You know, he actually made quite a point for Nigerian universities, which I thought was amazing. Maybe that's why you and I are not tech investors. Because
what you know about my life, Ngozi? No, I thought it's a really important case, and I think that if we're going to solve Nigerian problems, you need Nigerian entrepreneurs. You need people who really understand it, and I think Nigeria has been a really impressive market in the quality of founders who are born, raised, and educated here. We used to talk about sort of Kenya, which is a market in which lots more foreign founders come into that market and build LinkedIn here. But some of the most important companies in Nigeria's tech ecosystem have been built by people who really have been educated here, have been steeped in the challenges here, and they have a grit and a willingness and understanding of the market that allows them to really sort of deliver what is required in this market. And it's been impressive. So I look forward to seeing more of those.
This is what fuels my passion for training, right, and digital skilling, especially because we have the numbers and we have the opportunity to create. We've seen it been done before. And so the onus is on us in the private sector and also to the government, right, to say, what are we doing with the 70% of our population that are under the age of 35?
To make sure they have the skills to build the world that we're...
Yes, the next Flutterwave and the next Paystack. Why not?
Excellent. Absolutely.
Thank you for joining us on Tech into the Future. Join us next week as we take you into the business and impact of technology in Africa, how it's changing the world and how it's changing your world. Stay tuned on Arise News.